Hello everyone, welcome to ACCA P6 UK lectures. We are at inheritance tax. In the previous video lecture, I covered both F6 and P6 aspects of inheritance tax. So in this video lecture, we will just open up our P6 lecture notes and we will see that how far have we covered so far from our P6 lecture notes. Now if you could please open your not BPP exam kit, the AccountancyTube lecture notes, chapter number 18, 19 and 20, and it's page number 66 of your P6 lecture notes. So as you can see on your screen as well, inheritance tax. Now it is exactly the same stuff which we have already seen, gifts made during the lifetime of the donor and assets transferred on death, and I've shown you on the board as well. So we made a little diagram on the board and I shown you in details and I explained you as well. So it is there will be one lifetime transfer and there will be one death transfer as well. For our current tax year, these are the rates for our current tax year. Up to nil rate band, which is £325,000 for our current tax year, there won't be any tax. And for residents, nil rate band up to £100,000. So residents nil rate band will also be available when the estate has transferred on death of an individual, and that estate include the main residence. And then in that case, and also it is transferred to the direct relative, then first £100,000 will be at the rate of 0%, and any excess will be taxable at the rate of 40%. Please remember that it is a death tax rate. However, for lifetime there will be half rate. And again, if it is a CLT, of course the lifetime tax will be on the chargeable lifetime transfers only. So if it is transferred, who is paying the tax? If the transfer is paying the tax, then it will be tax rate at the rate of 25%. However, if the transferee is paying, the trustee is paying, then it will be at the rate of 20%. Right? Now, residence nil rate band is explained you in the details below. Now, for our P6 students, the residence nil rate band we have already seen in our previous video anyway. However, we haven't seen residence, the reduced residence nil rate band. Now, in certain circumstances, now it is only relevant to P6. We haven't seen that in the earlier video. So the residence nil rate band of £100,000 will be reduced in certain circumstances. So what are these? Additional nil rate band is reduced where value of deceased estate before deduction of APR, BPR and exemptions. What are these APR, BPR? We will see in a couple of minutes, time. What are APR is agricultural property relief and BPR is business property relief. So we'll see that in details, so you don't have to worry about that. However, after deduction of that, exemption is in excess of, before deduction of these exemptions, if the estate is in excess of £2 million, then the residence nil rate band will be reduced. How it will be reduced? It will be reduced in the exact same way, like we use our, the personal allowance or the tapered, the tapered annual allowance for pension purposes, right? So it says that it will be reduced by half of the excess over £2 million. So every £2 in excess of 2 million, the residence nil rate band will be reduced by £1. Right. So after that, it says a lifetime transfer. So there are two types of transfer: potentially exempt transfer and chargeable lifetime transfers. We have seen that in our previous video as well. On page number 67, exemptions. Exemptions applying to pets only. Small gift exemptions, we have seen that. And exemptions applying to pet and CLT only, and annual exemption every year. We get annual exemption £3,000 every year, and we can brought forward as well. We can the carry forward for next year. However, we use that after that year's own annual exemption has been used. Normal expenditure out of income, we have seen that as well. So this will be exempt as well, because inheritance tax is a capital tax. It's not income tax, as I explained you. So that's why that will be exempt as well. Now, gifts on occasion of marriage, £5,000 from parent of a party to the marriage, and £2,500 if it is from the grandparent, and £1,000 from any other party. Now, these are the gifts applying on all of these. So pet, CLT and death estate. So these are the exemptions basically, and there are four types of exemptions. In our previous video, we only looked at the spouse one. We haven't looked at the remaining bits. So these are the four exemptions. First of which is gift between spouses. So if husband transfers an asset or the wife transfers an asset to a husband, so it will be exempt. All right. Now, Any transfer of value between spouses are exempt provided the transfer is domiciled in the UK. So there is another aspect as well in this case, which is also additional to the P6 students. So a transfer of value between spouses are exempt provided the transfer is domiciled in the UK. So it will only be exempt if the transfer is domiciled in the UK. However, if it is not domiciled in the UK, then there will be exemption of £325,000 and in excess of that gift, and it will be considered as potentially exempt transfer. Right, so at the time of excuse me, so the transfer is domiciled in the UK at the time of the transfer. The exemptions covers both lifetime transfers and the death estate. A simple planning point of view follows from this exemption, as spouses may avoid IHT if each makes a will leaving the property to another person. Now, what would happen is that it says that normal, the tax planning point of view is that they will make an agreement that the estate, whenever one party of the spouse, so either husband or wife, so they will make a mutual agreement that if I die, then I will transfer my assets to you. If you die, you will transfer your assets to me. So in that way, we will be exempt from IHT. Now, if the transfer spouse is domiciled in the UK, but the transfer spouse is not domiciled in the UK, so transfer is not domiciled, then in that case, the exemption is limited to the cumulative total of £325,000. But any gift in excess of £325,000 will be a potential exempt transfer. Now, please remember, do not confuse this £325,000 with the nil rate band. Now, nil rate band is additional thing. This is exemption only. This exemption only applies where the transferee spouse is not domiciled in the UK. Right? Now, they will still get nil rate band. So the first £325,000 will be exemption. You will state to the examiner why it is exempt, because the transferee was not domiciled in the UK, and whatever the excess is on that, we will have to calculate IHT. So the first £325,000 is at the rate of 0%, which is the nil rate band, and any excess, and then we'll calculate the IHT at the rate of 40%, 20 or 25%. Right, on the next page, if you see, there are some more exemptions as well on page number 68, I think. Yep, 68. So there are other exemptions. The transfers to UK charities. So first exemption was when we are transferring to the spouse. So that is one exemption. As I said, there will be 4 of them total. So when you transfer to the UK charities, that will be exempt as well. Gift to qualifying political parties also exempt. So what is qualifying political party? Now they will have 2 members elected in the House of Commons, or 1 member elected but who got 150,000 votes. All right, in the recent general election, one member was elected in the party pool at least 150 votes. After that, it says gift for national purposes are also exempt. Eligible recipients include museums and galleries only. So if you give the gift to these things, then it will be exempt. Now, how many parties are there? So as I said, there will be 4 exempt parties. What are these? One is spouse, then is national purposes, then donations as well, and the last one is the qualifying political party. So these are the 4 exempt parties. All right. Right then. So lifetime tax on lifetime transfers. So we know that there won't be any lifetime tax on PET, and if the individual survives for 7 years, then there won't be on death as well. Likewise, for CLT, although we will have to pay tax during lifetime, but we will not have to pay tax on death if we survive for 7 years. All right, and for CLT purposes, when we are calculating tax at death, we will take the gross amount, if you remember. All right. So how will we calculate? There are a couple of steps, as you can see on your screen. Now, if the transfer pays, it's a different rate, and if the transferee pays, it's a different rate. So we've already seen that in the previous video anyway. So you just have to revise. And on the next page, if you move, it's death tax on the lifetime transfers, PETs and CLTs, and this is also exactly the same thing which we have seen in our previous video. So I don't want to revise this again. So you will just have to revise it. And then on death tax, if you have survived for more than 3 years, then it will be reduced by the taper relief as well. All right. So we have seen that in the previous video as well. Now, the valuation of assets for IHT purposes, we know that it will be diminution in value. So we'll take the value before transfer and value after transfer. Whatever the difference is, that will be diminution in value. Now, that was the bit which we have seen in our F6 as well, in the previous video lecture as well. So it is exactly the same thing. However, for P6 purposes, there is additional rule with regards to the diminution in value, which is known as valuing related property, right? Valuing related property. Now, say for example, if I hold shares in a company, and one of the exempt parties, so how many exempt parties were there? There were political parties, there were national purposes, there were spouse as well. So if any of them hold the shares in that company, if the shares were transferred for that purposes, or if any of them parties hold shares in that company, then that will be considered that will also be considered in the percentage of the transfer. Say for example, if I as a transferor hold 50% in the company, and my wife hold 10% as well, then it will be considered that my holding is 60%, although it will excuse me, it will actually be 50%, but it will be considered 60%. So I will have to check the share price of what the 60% shareholding is. Right? So it says that for IHT purposes, related property must be valued as a proportion of the value of the whole of the related property, only if it gives higher value than diminution value. So we'll only use it if it gives higher than diminution value. So we will use including value-added property and excluding value-added property. Whichever gives the highest value, we'll use that one. And related property of an individual must be valued including the property of the spouse, property given to charity, property given to political party, and property given to for the national purposes. So as I said to you earlier as well, that if I hold shares in a company and the shares were also used for the exempt parties purposes, so there were four exempt parties: spouse, charity, qualifying political party, and national purposes. So if I have given the shares for them purposes from that company, then that will be considered as my holding. If I hold 50% shareholding and I've given 10% to the charity, then that will mean that I hold 60% in that. So I'll use the share price at the rate of 60%. So whatever the share price of 60% is, so I will use that one. Alright, and I will only use that if it gives higher value than the diminution value. Alright, when part or whole of the related property is sold, then the value of the transfer for IHT purposes will be higher of these two: value of transfer without related property rules using diminution value, and value of transfer using related property rules. And it says learn the method in class lecture. Now we have already seen that how we calculate for diminution in value, but how we calculate for related property, we haven't seen that. So we will do one past exam paper. It's a question from the past exam paper with regards to that. Now if you could open your BPP exam kit and come to question number 11 of BPP exam kit. I'm talking about the current version of BPP exam kit, which is Finance Act 17. Question number 11 of BPP exam kit. Question name is Brad. If you have any other exam kit, question name is Brad, and it was examined in June 2013. Right? Now, it is a huge question, 25-mark question. We are going to do part B of this question. We've already done the capital gains tax part of it in our capital gains tax section. So we are now doing inheritance tax. In part A, it says in the requirement 7 marks, explanation of the inheritance tax advantages of making lifetime gifts to individuals. Now, in our previous video, if you remember, I told you that what are the advantages of making lifetime gift, right? If you're still not sure what are the advantages, then go to the page number. Let me see which page number it is in our P6 notes. In our P6 notes, the page number is 77. Page number 77 of the page number 77 of AccountancyTube lecture notes. All right, so you will have to list down all of them here in order to gain 7 marks. Easy peasy, lemon squeezy. All right, then after that it says in part B2, in respect of the possible gift of 1500 shares in Omnium Limited to Danny. So what we have to do now, we'll have to see the email from our manager, which is given above that. So in inheritance tax, it says part 1, explanation of the inheritance tax advantages of making lifetime gift to individuals in general. So it is a general information, so you just have to copy from the notes and paste it into your exam paper so that you will get the full marks. However, sometimes examiner asks you specifically relevant to the scenario. In that case, you will have to incorporate it into the scenario. Right then. So in the part A2, it says, in respect of the possible gift of 1500 shares in Omnium Limited to Danny. So there was a gift of 1500 shares in Omnium Limited to Danny. I don't know who Danny is. We will read the scenario. Anyway, in part B2.1, a calculation of fall-in value of Brad's estate, which will result from the gift. So we have to calculate the fall-in value. A detailed explanation of whether or not the business property relief would be available. We will have to determine whether or not the business property relief will be available in respect of the gift, and on the assumption that it would be available, the manner in which it would be calculated. So we will leave this for now. We will read the business property relief in a minute. Then we will answer this part of the question as well. And in 3, a brief statement of any other tax issues as well. Right. So if we read the question from the start, on the previous page, where it says inheritance tax planning. So Brad's estate is worth approximately £5 million, so the residence nil rate ban will not be applicable. Alright, so it's £5 million, residence nil rate ban will not be applicable. Why would it not be applicable? Because when it is more than £2 million, we know that it will be reduced anyway. So when it is, if say for example, if it is 2.2 million, then of course, you know, we know that it will, the residence nil rate ban will be reduced to 0. So that's why it says it is not applicable. He has not made any lifetime gifts, and in his will he intends to leave half of his estate to his daughter Danny. So he's leaving estate to Danny's daughter, and other half to his wife Laura. I pointed out that it may be advantageous to make lifetime gift to Danny of assets other than his main residence. So he's saying that make it a gift during lifetime, and he agreed. So Brad agreed to consider giving Danny 1500 of his shares in Omnium Limited. So he's giving 1500 of his shares in Omnium Limited, and has asked for a general summary of inheritance tax advantages of making the gift to individuals. On the next page, it says Omnium Limited is an unquoted manufacturing company. So it is an unquoted company, and it's a manufacturing company which also owns number of investment properties. So it holds investment property as well. Brad was, now this information, the unquoted company and investment property, this information is relevant for the business property relief. So when we study business property relief, then you will understand it in a better way. Brad was given his shares in a company by his wife on 1st of January 2014. Now Brad got these shares in 2014. This information is also relevant for business property relief. The ownership of the share capital of Omnium Limited is as follows. So this is the share capital ownership in Omnium Limited. Now Laura, who is Brad's wife, owns 4,500 shares. Brad owns 3,000. Vic, who is Laura's brother, 1,500 shares, and Christian, who is friend of Laura, owns 1,000 shares. So altogether 10,000 shares. Now Brad's shareholding is 3,000, which is 30%. And the prices are given, value per share is given below. Now we will do 2 calculations, as I said to you earlier as well. So we will do on one side, on the left side, we will do calculations, diminution in value excluding related property, and on the right side, diminution in value including relevant property, related property. Alright, so you can do like that as well, or just do the excluding related property first, and beneath that, or on the next page, do the diminution in value including related property. Alright, so whichever gives the higher value, we will use that one. So let's do, I will just go through the question, so you will have to do it yourself. I don't want to do it on the board, because if I do it, then you will just you'll be just following me. So it's better to do the question yourself, and then if you have any problem, just drop an email, or if you don't want to drop me an email, if you want an instant answer, and if you're clever enough, just check the answer from the back side of the exam kit. Normally there isn't any mistake in them. Alright, so let's see then, excluding related property. So if we are excluding related property, what we have studied in the diminution in value, we know we will calculate the value of the Brad's estate before transfer of the gift and value of estate after transfer of the gift. So what was the Brad's value before transfer of the gift? So Brad had 30% shareholding, 3,000 shares, and the price of shares, if you hold 3,000 shares, now if you hold 26% to 50%, the value of per share is 205. So that will be the share price of Brad before transfer. So 205 multiplied by 3,000 shares, that's the value of Brad's shares before transfer. Now value of Brad's share after transfer would be 1,500 shares, because he already given 1,500 shares to the daughter. Alright, so the Brad's remaining shareholding is 15%, and price, if you hold up to 25%, if you have up to 25% shareholding in the company, then the value per share is 190. Now in that case we'll have to multiply 190 multiplied by 1,500 shares, so that is the value after the gift. So whatever the difference is, that is diminution in value, and that is diminution in value excluding related property. Alright, now after that we will do the the diminution in value including related property, and when we include related property, so the calculation will be like this. So we'll calculate value of Brad's estate before the transfer of the gift, including related property. So the value of estate is 3,000 his shares, and are there any exempt parties in here? Yes, Brad's wife is exempt party, so we'll include them shareholding as well. So in that case total shareholding is 75% in that company. Alright, so total shareholding is 75% in that company. However, Brad's actual shares are 3,000, so we'll take actual shares 3,000, but we will use per share price of 75% shareholding. Alright, so we'll take 3,000 shares multiplied by what is the share price if you hold 75% shareholding? It's 75 to 80%, 290. So 290 multiplied by 3,000 actual shares of Brad, so that is the value before transfer. Then we will have to deduct the value after transfer. So what would be the value after transfer? After transfer, Brad would have had 1,500 shares, and his wife would have had the exactly same 4,500 shares. So his shareholding would be 60%. His assumed shareholding would be 60%. So if we hold 60% shareholding, 51 to 60% is 240 pounds per share. Alright, in that case we'll have to multiply 240 pounds multiplied by the remaining shares of Brad, which are 1,500. So 240 multiplied by 1,500, so that is the value after transfer including related property. Right, so value before transfer including related property, and value after transfer including related property, and the remaining amount is the diminution in value. Now this second calculation, diminution in value, is the diminution in value considering the related property as well. Alright, so we have done two calculations, diminution in value excluding related property and diminution in value including related property. Whichever gives the higher value, that will be the value of the transfer. Alright, so we have already answered. So the requirement was in respect of the possible gift of 1,500 shares in Omnium Limited to Danny, calculation of foreign value in the Brad estate which will result from the gift, and a detailed explanation of whether or not the business property relief. So we will see that later on when we move to the business property relief. For now, just move on to lecture notes, please. Again, now on the lecture notes, as you can see, this is a valuing related property. Now just beneath that is quoted shares and securities. Now how to calculate the value of the quoted shares? It is exactly the same way like we do in capital gains tax, but there is just minor difference. We do in the capital gains tax, we'll take lower value, lower quoted price plus one half of the difference between higher quoted price and the lower quoted price. That's how we do it in capital gains. So take one half of the difference between the higher quoted price and the lower quoted price, whereas in inheritance tax we'll take 1/4 of the difference between higher quoted price and lower quoted price, and we'll have to add the lower quoted price into it. And the B option is highest market bargain plus the lowest, so that is basically average of the market bargain, and whichever is lower, so we'll take that. And after that, unquoted share price, and now it will be given to us in the exam. Now unit trust, so there will be prices given to us, so we'll take lower of them. So units in authorized unit trusts are valued at the manager's bid price, the lower of two published prices. Life assurance policies. Now, where a person's asset include a life policy which matures on his death. Now, if I had a life assurance policy when I die, now I will receive money. I won't receive, but the person who I transferred the assets, that person, or with whom whoever the recipient of that insurance is, that person will receive the insurance proceeds. Now we will take the actual proceeds, right? Now that's what it said. The proceeds payable to the personal representative must be included in his estate for IHT purposes. However, if I had an insurance which matures, now if I had an insurance that does not mature on my death, but that matures on my wife's death, in that case we will have to take the market value. All right. After that, it says on overseas properties, the basis of valuation is same as for UK property. Overseas debts are deducted out of that. Now, if we have an overseas property, and sometimes if we want to realize the value of that, we want to bring the money, then we will have to we might have to pay some taxes. We might have to pay to the solicitor in that country. So there will be few deductions. So up to 5% of that can be deducted out of that. On the next page, if you move now, it is a business property relief. So that is the last topic of this video lecture. What is business property relief? Now, business property relief can reduce the value of asset by 100% or 50%. Now, the relevant business property is A, B, C, D, and E. Now, the conditions A, B, and C, there will be 100% business property relief, whereas for D and E, there will be 50% business property relief if you want to list down. However, if you don't want to write it down, then the information is given below anyway. So in the A, it says business property is a property consisting of a business or an interest. So if you have an interest in the partnership, shareholding in the partnership, in that case as well. Right, so business property relief will be available. Securities of a company which are unquoted and which gives the transfer control of the company immediately before the transfer. So it was unquoted company, security in an unquoted company in which you had a control before the transfer. Any unquoted shares, now it is unquoted shares, not the securities, it says in a company, and then shares or securities of a company which is quoted, which the transfer had control immediately before the transfer. Right, and again in this case and in the previous case as well, control may be achieved by taking into account the related property. So take the related property as well, and any land and building or plant and machinery which immediately before the transfer were used for the purposes of business of the company. Right, so this case and the D case where it says share or securities of a company which are quoted. Now on these two there will be 50%, and from A to C, the business property relief will be at the rate of 100%. Right. Right, then after that it says that shares or securities in AIM. What are AIM? AIM are the alternative investment markets. The business property relief available are percentage reductions in value transferred. So 100% for assets within para A, B, or C, and 50% for the D and E. Shares or securities on AIM counts as unquoted company. AIM are the alternative investment market. So if there are shares or securities on that will be considered as unquoted. Now, business property relief, as I said earlier as well, for A, B, and C, there will be 100% and 50% for the assets within D and E. Relevant business property for BPO purposes exclude assets of a company which were not used for business purposes, as I said as well. Now, what are the conditions for business property relief? Now, it applicable to all of these. What are the conditions? Now, it must have been owned by the transfer for at least 2 years before the transfer, and if it wasn't owned, then it was replaced by another business property where combined period of ownership of both sets of property was at least 2 years of the last 5 years. Now, if these conditions does not apply, the business property relief still will be available if the asset was transferred on death, and on date of death the business property relief was available. In that case as well, the business property relief will be eligible. Non-qualifying assets for business property relief that include the dealing in securities, dealing in land and building, and making or holding the investments. Right. So on the next page, it is agricultural property relief. So we will see that later on. Let's do a question now. The same question which we had opened earlier. Please open the same question. Now read the requirement again. Requirement number B. In the A part it says explanation of advantages of making lifetime transfers. We have done that. In part 2.1 it says calculation. We have done that. In part B2.2 it says a detailed explanation of whether or not the business property relief would be available in respect of the gift, and on the assumption that it was available, the manner in which it would be calculated. Alright, now first we have to determine if the business property relief would be available or not. Now, first of all, it says Omni Limited is an unquoted manufacturing company, so it is an unquoted company. The condition fulfills the criteria of business property relief. So business property relief would be available at the rate of 100%, right? And which owns a number of investment properties. Now there is it owns the investment properties. There is one condition of for the qualification of business property relief, that the business must not be dealing with the investment properties. Now we'll have to see that what percentage of business consists on the investment properties. If significant investments, if they are dealing with if their investment proportion is significant, then the business property relief will not be available. And then Brad was given his shares in the company in 2014, so the minimum holding period of 2 years is also, minimum ownership period of 2 years also applied, and the ownership of the share capital was as follows. So that's not relevant. So business property relief will be available for at the rate of 100%. Now, after that it says that assuming that if it applies 100%. Assuming that business property relief will be applied, how would we calculate? Now normally we calculate it at the rate of 100%, so it will be value will be reduced at the rate of 100%. Sometimes there are some accepted assets as well. Alright, so the assets which are not used for business purposes, so them are accepted assets. So we will only take the the business property relief for the non-accepted assets. What are the other issues? Now we will have to also see the capital gains tax aspect of this gift. So in that case, the gift relief will be available. But because it is dealing with the investment property, again we'll have to see the significance of that. Now in that case, the gift relief might be restricted as well. However, as far as stamp duties are concerned, which we haven't seen so far, there is that aspect as well, but we will leave it for now. Sometimes we'll have to pay the stamp duties tax as well, but in this case it won't be available. It won't be payable. Right, so that's it for this video lecture. In the next video lecture, we'll continue our journey with inheritance tax. We'll do some more questions as well. I will see you in the next video then. Goodbye.